welcome to the Stockout. Hope everyone's having a good Friday. I'm Mike Baudendistel of FreightWaves, market expert here and analyst at FreightWaves. Follow the rail industry closely. I'm also do a lot of the writing for the Passport Research Group. So this week, we'll be talking about some high-level trends that are impacting the CPG companies on the show about CPG companies and their supply chains, which include the widespread issue of the U.S. Birth rate continuing to plummet, hitting new lows. In the past year, we got new data out on that. This week, and then a number of CPG companies reported earnings this week. I'll start to give some of a rundown on some of those reports. Still going through them myself. We've seen some stock volatility on some of the widely followed names here. But first, before I do that, a word from our sponsor, Echo Global Logistics. Trust the experts at Echo Global Logistics for all your freight transportation and CPG shipping needs. Whether you are a Fortune 100 CPG company or specialty food manufacturer, Echo has solutions to fit your needs. With their dedicated team, as well as Echo Ship, a self-service shipping portal allowing you to quote, book, ship, and track, Echo has you covered. Technology at your fingertips and experts by your side, 24 hours a day, 7 days a week. To find out how Echo can simplify your transportation management, please visit www.echo.com/CPG today. So big thanks from Echo Global Logistics. And with that, I'll launch into my topic of the week. And I think this is something that has huge implications for CPG. And I'll sort of walk through this. Sort of the data came out this week on U.S. birth rates. And what's taken place in the past year. So the 2020 birth rate was down 4%. So the number of births were down 4%, 3.61 million in 2020. So down 4% from 2019. And this was actually the lowest birth rate. If they extrapolate this out, the number of births a woman would give children and women would give birth to in their lifetime would be 1.637. And that's versus a replacement rate of 2.1. It's also the lowest birth rate in history since the country has been keeping these statistics in 1930. And some other interesting stats is you look at what's happening with the pandemic, and really the pandemic should have only hit the December birth rates. And you look at those specifically; those were down 7.7%. So certainly a little bit worse than the down 4%. But still, this seems like it's more of a cultural issue, more of a generational issue. What's interesting also is you look at some of the other countries around the world and what's happened with their birth rates in December. And Italy is down 21%. A number of sort of large countries had it down high teens into 20% range. And so I think when the pandemic hit, people were didn't know whether this was going to give rise to baby boom or baby bust. I think that question has been answered. It's a baby bust, and I think there's going to be little that's going to change that as far as the government promising larger child tax credits. Biden administration talking about larger tax credits, larger child care subsidies, those type of things. You look at what happens when those take place in other countries like in Northern Europe. I mean those. Birth rates continue to fall and are well below where they are in the U.S. have been for some time, and in countries like Germany and various places in Northern Europe. So it does seem like to be more of a cultural thing. But I thought that 1.637 birth rate is pretty shocking, and especially in the context of reduced volume of immigration, coming into the U.S. For the past few years, and the reason this matters for CPG. I mean, CPG is an unusual industry in that what is consumed has more to do with population and the number of people. You think about what CPG, consumer packaged goods, are. It's a lot of food, a lot of beverages, cosmetics. Personal care products, toiletries, things of that nature, soaps, a lot of things that are just really just sort of scales with population, much more so than with income or with economic growth rate. I think parents buy paper towels and diapers, whether the stock market was up 300 points today or down 300 points today. And so this is, really sort of speaks to, if you were to project out, revenue growth for, these companies, you would have to think, well, maybe they really only are 1 or 2%, growers, per year. If you sort of think of the U.S. population as growing, less than 1%, and that includes, immigration, with the potential that could, decline. So it's big implications for, I think, CPG companies, and big implications for transportation industry as well. One of the interesting, stats I've seen over the years is the, comparing the tonnage, the freight tonnage that's, moved, and you compare that to the number of people, or the population, and it's remarkably consistent, where the tonnage per capita that's moved is, tends to be pretty stable, and it tends not to be, for that reason, a fast growth area. I mean, the sectors of the economy that tend to grow, faster than population, are things like services. They are things like technology that, either, don't require a lot of freight, require very little freight, things that can be miniaturized. But CPG, to a large extent, grows sort of with the population. So this is something to keep an eye on, as we see, the following months, come out. Another interesting stat I saw in this was the Brookings Institution estimates that 300,000 fewer babies will be born in 2021 as a result of the pandemic, and compared to 2020. So that really takes a bite out of companies that produce things like diapers and wipes today, and then later on those become consumers of other things, of course. Sort of sticking on this topic, the Honest Company went public on Wednesday. I've talked about the Honest Company before and written about them. They're the company that was founded 10 years ago by actress Jessica Alba, and I think this is an interesting one because they are taking such, and there she is there. What's interesting about this company is they've taken such an approach where a lot of these products that they sell are made by much larger companies, companies like Procter & Gamble, Kimberly Clark. They're not going to be able to compete with those companies on price, but they've taken the approach that they can offer a premium product in those spaces that by way of not having chemicals, not having a lot of sort of harmful things to the environment, those type of things. The company started out with diapers and wipes, going into other things, but the company went public on Wednesday. I had talked about their S1 filing a little while ago, but it went up 44% the first day, so a really nice bounce. I think most investment bankers tend to if you want to be suspicious, underprice where they think it's really going to trade by 10, 15, 20%. And so you typically see that 10 to 20% bounce. So it bounced 44% the first day. It has since retreated, but it's still up, I think about 18 or 19% for the week. So it opened at $16, traded up to, I think, 23, and it's back to 19, but still up, $3 for the week. And I think this is going to be an interesting one to follow because I think it's going to test the market for the premium products, in the CPG space. The company claims that its category is growing 9 to 10%, per year, which is high when you think about some of those population growth rates, which I was just talking about, which are not really high, and that's sort of what you see when you look at the Procter and Gambles of the world, and those categories of baby products. Those are only growing 1 or 2% per year, and some of that is price. So I think it tests the size of that market, and I think it tests the capital markets to how much are they really going to pay a premium for securities that they view as being higher growth sectors within CPG. There's some question of how much share they can take, or is it just there's really good product, or there's just a function of this is a celebrity that has an absolutely huge following. But coming down the pipeline here, we are going to see some other IPOs that I think are going to be interesting. Oatley is the maker of oat milk that you can now try for yourself at your local Starbucks. They have a partnership now with Starbucks, and you see their advertising. It has a lot of these sort of edgy, ads, and sort of get your attention. But so oat milk is fast becoming at least the quickest, the largest sort of synthetic milk, if you want to call it that. They're just below almond milk in terms of plant grown sort of milk alternatives, but with their extra capital, could easily see growth there. And then Impossible Foods, may go public, later this year, which is a company that I'm interested in. I think they have a better product than Beyond Meat, which I see is down about 7% today. They reported earnings last night, and I can talk about that. If we have time. So keep an eye out for oat milk and Impossible Foods. And with that is a little bit of kind of on the theme of Mother's Day. I think I'll switch gears a little bit and talk about a report that spent most of the last 2 days, probably Wednesday and Thursday, drafting up. Went out to the Passport Research Group. People subscribe to Passport. It went out yet last night, and I titled the report "Trucking When the Economy Sizzles," which there's the report there. If you want a copy of it, let me know. I'll send it to you. This is sort of my perspective is the economy is getting overheated. I think a lot of the people in Washington D.C. are saying no, it's not. Don't be concerned about inflation. Not sure what they're looking at really. I think that inflation is pretty widespread. Is very widespread. It seems to be hitting lots of inputs in various goods. It's hitting manufacturing. It's hitting packaging, hitting transportation costs, hitting labor. The price of lumber is skyrocketed. The price of steel is skyrocketed. The price of resin is skyrocketed. The price of all these agriculture commodities, corn, soybeans, wheat, all of these things are rising in prices, and they're going to find their way into consumers. And so I'm sort of a believer that the government has been sort of way too generous with these stimulus packages and with keeping interest rates at or near zero for way too long. And I think it's just going to end up some people are going to lose ground to inflation, unfortunately. But with that as sort of my sort of macro thought. I talked a lot about the trucking market, sort of from the perspective of the asset carriers. And I know a lot of the people who watch the show, it's really sort of targeted to the CPG companies. So sort of looking at it from the other team's playbook, but think in the context of this very strong economy that's maybe overheated. The trucking companies, I talked about how their rates are rising. In a lot of cases, look at the overall spot rates. Not only are the spot rates higher, but there's also a lot more spot volume. This chart that you're looking at there is the operating ratio for the dry van companies in blue. So things that don't need to be refrigerated. The operating ratio. So that's 1 minus the operating margin. So lower is better from the perspective of the carriers. A lower operating ratio is a higher margin, and in orange, the operating ratio for the refrigerated companies. And so basically, the margins of both the dry van companies and the refrigerating companies have improved. Their operating ratios have come down. And so for all the cost pressure that the trucking companies are having with paying drivers more, with paying higher insurance costs, with paying higher fueling costs, with all of the freight imbalances that the trucking companies have to deal with, which are more than they typically would be, these companies are still earning higher margins. And so if I'm a CPG shipper, I need to sort of understand that it's a carrier's market right now, and have to do what I can to make myself a preferred shipper. And this chart I think is an illustration of that. So this is the trend here is down. So this is the empty mile percentage. So if you run 100 miles and 90 of them are loaded and 10 of them are empty because you have to go out of route, that would be a 10% empty mile percentage. So you want this to be lower, and it has come down. And it has come down because the carriers, because it is a carrier's market, the carriers can accept freight that's advantageous to them, which is to a large extent freight that is not going to force them to go out of route. So they for instance they go to Chicago. Chicago is what's considered a head haul market because more freight comes out of Chicago than goes into Chicago. It's a hub city. It's easy to get reloaded there. So the loads that are going, say, inbound to Chicago are relatively easy to get a truck who's willing to go to Chicago, because it's a big, city that's easy to get reloaded. But carriers are much less willing to go to a city where it's more difficult. And what we've seen with our tender rejection data in Sonar is the tightest freight markets, the markets where the shippers have the hardest time getting a truck, are a lot of the smaller markets. So places like Fayetteville or Tulsa or Jefferson City, or some of these smaller markets, and it's relatively easy to get a truck in Los Angeles or Chicago, because carriers are willing to go there. They're not willing to go very far out of route. They want to stay in sort of those dense freight corridors where could potentially have head haul freight on both sides. And so so in addition to there being a lot of inflation in rates, which there is, and we got some more detail on that. This week, Hub Group, the big domestic intermodal company, said that their contract renewals are up, 10%, plus, year over year, and so a lot of those contracts that had been maybe not priced high enough to reflect the current market are starting to turn over and get priced at much higher rates. We've seen that in the trucking market as well, where some of the large publicly traded trucking companies are saying that their rates are up double digits also. So I think it's a difficult situation for refrigerated shippers, which includes a lot of the CPG companies. A lot of consumer packaged goods are things like food or ice cream or things that or even cosmetics that need to have temperature controls. And one of the patterns we've seen is a higher tender rejection rate for on refrigerated loads than on dry van loads. Dry van tender rejection rate is about 25%. So carriers are rejecting about 1 out of 4 tendered loads to them. For refrigerated, it's about 40%. So it's certainly higher. So difficult time to be a shipper and in the CPG industry, and it's also difficult for those that deal with chicken. I probably saw the article that came out today. The chicken prices are rising significantly. Wingstop reported paying 26% more for bone in chicken wings. Those look good. Down there, but they might be more difficult to find. Some of the smaller and mid-sized chains are reporting not getting the type of chicken tenders they need, sort of stocking out completely. And the larger chains like a Wingstop, that's nationwide, they're paying quite a bit more. So you probably see that tacked on to in higher prices on your bill. I can sort of quantify this in a couple different ways here. Boneless chicken breast trading at $2.04 a pound. The average the last decade is $1.30, $2.32. So about 54% higher than what's typical. And people are blaming this on this sort of silly fad of fast food restaurants offering more chicken sandwiches, which I guess have their audience. All these fast food restaurants have rolled out chicken sandwiches, but it's probably a scapegoat. It's probably the fact that you're seeing shortages of lots of different types of food, higher prices for feed. Those companies are having a hard time getting the workers they need with the sort of labor shortage. So having lots of problems sort of throughout the supply chain. I'm not sure we should blame the fast food companies for offering chicken sandwiches. Next topic here is penalties from retailers, and we're starting to see these crop up. There's this article that came across, on that that I thought was interesting, and a lot of these big retailers like Walmart, telling suppliers that they require orders to be 90% full and on time, and that they're starting to charge a penalty. The suppliers that wouldn't charge would be charged 3% of the cost of the missing items. It's really, I think, the retailers that have a lot of clout that were able to do this, and those some of those rules were outlined sort of last year and are just did go into effect in April, and now we're having a difficult causing CPG shippers to have a difficult time. So CPG companies are sort of getting hit from a lot of different angles. Their input costs are rising, and then dealing with the retailers. can be challenge in and of itself. Move on to the next topic. I mean, one of the companies that I followed their earnings closely was Clorox. So Clorox wrote a new CPG newsletter, on this, which if you're not subscribed to that, you can go to FreightWaves.com/the Stockout and sign up for this. But sort of the main sort of takeaway from Clorox, there's some Clorox cleaning products on the screen there, is that their demand has really picked up since the pandemic hit. People have been doing a better job cleaning their house, cleaning their offices. I know we've done that at FreightWaves. They've asked people to stay out of the office so they can, deep clean it and so forth. And so they've raised, their production capacity quite a lot, using some, external manufacturing as well. So really ramped up, the number of, wipes that they're selling. These disinfectant wipes are one of the main sort of cleaning products. And, from there, it's not clear if the demand for those products is going to stay elevated. At least it looks like it is so far, where some of this might be one of the habits that sort of dies hard that we picked up, during the recession. But the company, is getting its margins squeezed. Its margins were contracted 320 basis points in the just reported fiscal third quarter. And so that's been driven by increased manufacturing costs, higher input costs, higher logistics costs, higher packaging costs, all of those things that are just sort of, we're becoming so used to, in the CPG, world. And what's different about Clorox is it doesn't feel like it can, really raise prices a whole lot on, some of those cleaning products, some of those disinfecting products, because it believes that, if it does that, it's going to, become the next, Twitter enemy, because enemy on Twitter, because they gouge prices during a pandemic. I don't see it that way. I think that if they were to raise prices, it would be very much in line with the input costs that are rising, and actually very consistent with similar CPG companies that use a lot of those same inputs. Like one of the inputs that they use that's really shot up in price is resin. Now resin gets used in a lot of plastics, and for Clorox gets used in the Glad garbage bags. And so it gets used in a lot of plastic type products. It also gets used heavily by companies like Procter and Gamble and Kimberly Clark, and products like diapers, things with plastics. And that was also impacted by the winter storm, which took a lot of the plants offline that are located close to the Gulf Coast. And so those prices are rising significantly, and you have seen those other companies, Procter and Gamble and Kimberly Clark, announce significant price increases. I mean, they've said they're going to raise prices, depending on product, mid single digits to high single digits, starting. I think Kimberly Clark said in July, and Procter and Gamble said in September. So you buy your baby products and personal care products now, they're going to go up in price. But with there, they don't have sort of the pressure that, okay, well, you're gouging on those things during a pandemic, because they aren't quite as associated with cleaning and disinfecting and those things. So Clorox is in a little bit of a tough spot, where they have to manage the public perception, in addition to investors expectations. So very difficult position to be in for large publicly traded company. The last company I'll talk about today is one that I think is always interesting. Beyond Meat. I've talked about them before. So this is a publicly traded fake meat seller, if you want to call it that. There's burger there that the idea with that advertising is that you are supposed to want to eat that, and eat it not because it's good for you, not because it's good for the environment, but because you want to eat it. So they're attracting the meat eaters among us. And shares were down today about 7%. Company lost 42 cents a share in the quarter they just reported. I think the consensus was that they were going to lose 21 cents. And a year ago, they actually eked out a profit of 6 cents. And they're blaming a lot of this on the recovery. They described it as sort of a thaw, out of the pandemic. Of course, a year ago, people went to the store and they stocked up on food, and there were shortages of meat, and I think that maybe there was some spillover effect where people were buying whatever was left on the shelf. If never bought a garden burger before, but if that's all that's left, if people are clearing store shelves, well, that's what I guess I'll buy, and some of those people like those things, and will continue with it. But now they're facing this difficult comp. Of course, the restaurants are still sort of closed. They do have a lot of partnerships, with those restaurants. But I really think sort of the reason the stock was down wasn't even wasn't the earnings loss. I think it was the revenue growth rate, which this company had been posting in recent quarters, growth of 100% or 90%, just some of these really tremendous growth rates, and that was only 11.4% in the quarter, which for a company trading at a very high multiple of revenue. I think that was disappointing. And I think there's also typically a high short interest in the stock, often above 25%. And I think some of that is just there's sort of a lack of consensus of whether this is going to be the Beyond meat is going to be a product that's really sustainable from a sales standpoint. And there's lots of competition with Impossible Foods, and from also these other big established companies, one of which is Tyson. And we'll hear more about that, I believe, when Tyson reports earnings on Monday. So with that rundown of the CPG industry, I think that's all we have time for. If you'd like to sign up for the Stockout newsletter, please go to www.freightwaves.com/the Stockout, and feel free to reach out to me at Baudendistel@freightwaves.com. And hope everyone has a great weekend and a great Mother's Day.